No, we have a bias towards, we look at markets, I think, across the globe. And if you ask me about, or our colleagues about China, for example, we would have a bias towards one or two cities. We don't want to go for the full spectrum. We have a bias towards one or two property types, things we can execute, things we know that if things go wrong, we'll have boots on the ground, people that actually can to make sure these assets stay income generating. And then we'll just weather the crisis in that respect. Look at Europe. We have a strong bias towards some what we call permanent locations. I think location is probably more important today than it ever was. We talked about obsolescence, long-term obsolescence. Just try and capture those trends, put as much demographics, technology, urbanization themes into your portfolios. I think that's the best hedge you can actually implement. And of course, you have to choose which risks you're comfortable with, irrespective of those black swans.
So the UK is leading the market in sort of risk management at the beta level using futures, probably because the IPD index is more used here. It's a benchmark for most of the funds. They know it. They use it on a day-to-day basis. So it's very simple for them to make the move to trade the index and use it for various different strategies to complement their portfolios. So yes, we're seeing an increase in sort of interest in it. Certainly at this point in the cycle, we're having lots of conversations about what people can do, a bit like we did before the general election last year. But it wasn't actually until the result, till the election had happened, that deals started to happen. And, I think we've seen that in the direct market this year, as well as the indirect market. People are just generally sitting on their hands and waiting until after the vote. But I think, with those questions you had earlier, I wanted to make the point that, on fundamental basis, property fundamentals, we're already overvalued historically on historical measures. However, that doesn't necessarily mean to say that this cycle hasn't got, more to go. You can be in sort of bubble territory, as I think I made the point in the presentation, but that can carry on for a good couple of years, depending on what's happening in capital markets. And that's very important to understand that linkage, because it's what's happening in capital markets that dictates what happens in real estate markets over the last couple of cycles. So the last cycle was all about debt availability, and when that dried up with the credit crunch, obviously property fell off a cliff. And to a certain extent, this time around, we've seen that debt availability come back. We've seen interest rates go to zero. And yet, relatively speaking, property still looks an attractive asset class because of the yield you can get over bonds without the equity market volatility. So by that metric, it's still very attractive. There's a lot of dry powder waiting to sort of pounce after the result of the referendum, or not, as the case may be. So, there's still a lot of factors to play out in this cycle. And whilst we're overvalued by general fundamental property metrics, that doesn't necessarily mean to say that we're going to have that 2 years sort of fall anytime soon, necessarily.
Okay. I mean, we see. I think on a relative basis, property still looks fair value against other asset classes, but those asset classes, the value of those is partly distorted through all these monetary initiatives like QE, etc. So we certainly see some of our clients, have a sort of concern about how that's likely to play out, and also a concern that there's so little growth, almost generally, globally in many ways, despite all these initiatives, and therefore how does that play out in terms of business plans, which are not necessarily assuming, but predicated on the assumption there's going to be rental growth, etc. You can't necessarily assume that if there's less growth. I think we find clients looking at, the so-called black swan events, but also what they call no-see-em events. which they mean didn't see that coming, which is sort of, I think, seemed to be a subcategory of black swan events. But it is, in some ways, a lot of the regulation that's come in, and obviously there's been a hell of a lot of regulation, was addressing the last crisis and can potentially have unintended consequences. Because the more regulation there is, which leads investors to invest in a certain way, the more capital is allocated to those, so the more potential there is for systemic risk. Banks now can't do any proprietary trading, so a lot of liquidity has gone from the fixed income market, which goes back to the capital value of those interests. Derivatives have been put through central counterparties, but now people are saying that there's a systemic risk with the central counterparties, etc. So there's all sorts of potential issues out there, which they're all interconnected in a way that probably is quite difficult to understand because of the way money works and is allocated actuarially, which creates potential for some unpredictability.
Yeah, that's the distortion I highlighted. When I really focused on what we're really worried about is that, our clients' balance sheets. If you're an insurance company or if you're a pension fund today, I think if regulation, for whatever reason, good intentions initially creates distortions in your allocation, then, we may be in for a tough ride. The last cycle or downturn was, debt bank / debt driven. The next one could be linked to pension funds and insurance groups.
So we see actually just picking up on that, where sort of annuity-based funds who are obviously taking the risk of a negative capital adjustment in the value of their fixed income securities actually say on one level, well, it will be less concerning because the corollary of interest rates going up is that the net present value of their liabilities will go down. So at least there's an element of balancing. Doesn't necessarily correlate. But just pick up on the funding side, throughout Europe, this so-called bail-in resolution procedures have been introduced for banks, where effectively local central banks can mandatory convert debt into subordinated equity when it's necessary to preserve the life of bank, and that's now happened to a Portuguese bank, where all the senior notes held by surprisingly non-Portuguese investors have been converted into equity and therefore have no value at all. And that's obviously there intended to keep banks going in difficult situations, but it's also creates a precedent which is unhelpful when banks want to raise money on the capital markets.